Good day and welcome to our students in the two LLM modules in banking law, as well as the newly introduced LLM module in credit law. I am Heinrich Schulze, one of your lecturers in the two LLM modules in banking law. In today's discussion, I will provide you with an explanation of the broad framework of banking law. I will explain to you the relevance and importance of banks in the economy, the distinction between public banking law and private banking law, and, in very broad terms, the current regulatory regime of South African banking law. The broad framework of South African banking law that I will present to you will hopefully assist you in having an holistic grasp and overview of South African banking law in general, and also to have a better understanding of where the topics that we offer in the two modules in banking law fit into the bigger and broader picture of banking law. Instead of providing you with a detailed discussion of any of the prescribed topics in banking law, I've decided that it will be better if I rather highlight a number of general principles regarding the structure and framework of banking law. This will hopefully assist you in having a better grasp of the bigger picture regarding banking law. Let me start by referring you to two fundamental principles in studying and understanding banking law. First of all, banking law is not an autonomous branch of the law, but rather an application of concepts and techniques of the general law of obligations as well as the law of things. Further, customary law and established banking usage play a rather important role as far as certain banking transactions are concerned. Secondly, and closely linked to the first principle, is the fact that the banker-client relationship is a multifaceted one. It invariably involves various types of contract, for example, mandate, loan for use, depositum, and deposit taking. The parties to the bank-client relationship may, depending on the circumstances, be either the debtor or the creditor. For example, if a client deposits money in his or her savings account, the client is the lender and the bank is the borrower. But if the same client applies for an overdraft on a current account, the roles would be reversed. This second principle gives the relationship its multifaceted nature, which involves various potentially competing legal principles. Later in my presentation, I will return to this phenomenon or principle that banks play a dual role. It acts as money lender, but also as borrower of money. Next, I would like to emphasize that banks play an important part in the function of the economy by performing various roles, including that of payment and loan intermediary, as well as provider of payment settlement facilities. Before I say more about the role of banks and their role as payment and loan intermediary, it is perhaps necessary to explain that there are two broad fields of banking law, namely public banking law and private banking law. Public banking law regulates the legal relationships between banks and organs of the state, such as the Registrar of Banks and other regulatory bodies tasked with supervising banking and the functions performed by banks. These organs of state and other regulatory bodies are in a position of authority regarding the banks and comprises those legal rules that make provision for control of the state of money and banking in general and the activities of banks in particular. The main purpose of public banking law are first to ensure that individual banking institutions are always in a position to honor the repayment obligations towards depositors. Secondly, to control the supply and the productive application of money and credit in the economy in furtherance of the monetary policy of the country. And thirdly, to provide and control methods of effecting payment in connection with foreign trade. Typical aspects that you will encounter in your studies in the LLM modules in banking law and which deal with public banking law include the provisions of the National Credit Act, money laundering, and the most important piece of legislation in the field of money laundering is the Financial Intelligence Centre Act, also the Banks Act, the South African Reserve Bank Act, and also the Financial Sector Regulation Act. Aspects which deal with public banking law usually deal with the tripartite relationship between a bank, a client, and the state, mostly in the state's capacity as legislator and enforcer of legislative provisions. When you work through the sections of the LLM modules in banking law, as well as that in credit law, which deal with public banking law, You will notice that legislation plays a very important role in regulating public banking law. I said earlier that there are two broad fields of banking law, namely public banking law and private banking law. I've explained public banking law now. Let's have a look at private banking law. Point 2 on the slide. Private banking law regulates the legal relationships between banks and their customers, and between banks and third parties who contract or are otherwise affected by banking activities. The law of obligations, that is, contract, delict, and enrichment, play an important role in governing private banking law. By the way, in South African law we refer to the law of delict. In English law, the equivalent of delict is the law of torts. In short, in the case of private banking law, the underlying legal principles are, to a large extent, to be found in common law principles of the law of obligations. The law of obligations, if I may refresh your memory, consists of contracts, delicts, and enrichment. Legislation plays a far less important role in regulating private banking law relationships. Topics which you will encounter in the LLM modules in banking law and credit law, and which typically form part of private banking law, include most of the topics dealing with payment and methods and instruments of payment. For example, credit cards, letters of credit, demand guarantees, stop and debit orders, the bank-client relationship, the bank as depository, electronic banking, and electronic funds transfers. At the beginning of my introduction to a broad framework of banking law, I referred to two of the more common roles that banks play in the economy, namely that of payment and loan intermediary, as well as provider of payment settlement facilities. What does it mean if I say that banks act as payment intermediary? Most payment methods and payment instruments, such as bills of exchange, stop orders, debit orders, letters of credit, demand guarantees, credit cards, and, of course, the electronic transfer of funds from a device such as a laptop or a mobile phone, require the intervention of a third party, which ensures that the amount that you want to transfer or pay to a third party is debited against your account and credited to the account of the receiver of the transfer or money. Traditionally, banks have had a near monopoly in providing payment platforms and acting as payment intermediary in ensuring that payments between parties are made and finalized, and that the necessary book entries are made. In the recent past, however, various other role players have also entered the market as payment intermediaries, notably mobile providers, but that does not take away from the fact that banks are still the most important and dominant example of a payment intermediary. Secondly, I would like to make one or two remarks on the role as banks as a loan intermediary. In layperson's terms, it simply means that the bank acts as intermediary in providing a platform and infrastructure for one group of people to invest money and for another group of people to borrow from such invested funds. The traditional role of banks has been that of loan intermediary, the bringing together of borrowers and lenders. Persons and institutions having surplus funds at their disposal deposit or invest such funds with banks. Banks, in turn, lend these funds to entrepreneurs who use them to launch new businesses or develop existing ones, and to consumers who use the funds for personal spending. Money is thus channeled from sectors where it would otherwise have accumulated without being used to sectors where it can be put to productive use. This in turn ensures a healthy circulation of money. It goes without saying that banks can only perform their traditional role of loan intermediary successfully and for a sustained period with a proper management of credit, liquidity, and interest rate risk. A failure to implement and sustain proper risk management systems will inevitably result in losses for banks and other lending institutions. When banks carelessly and inappropriately lend money to borrowers who fail to repay their loans, this may result in banks suddenly stopping or reducing lending activities. This may, in turn, result in what is known as a credit crunch or a credit squeeze, where it becomes extremely difficult for potential borrowers to borrow money from banks and for other lending activities to take place. In 2008, economies worldwide suffered the worst credit crunch in history. As a result of the 28 economic credit crunch, many countries, including South Africa, decided to overhaul the regulation of its financial industry. In this regard, I would like to refer you to the Financial Sector Regulation Act, which introduced the so-called Twin Peaks model of regulation in South Africa, and in which you will encounter in the Banking Law 1 module. Most of these countries have opted for what is generally referred to as this Twin Peak model of regulation. National legislation, as well as international standards and best practice guidelines, aim to ensure the continued effective functioning of the banking system. Public banking law regulates banking institutions and ensures their solvency, and private banking law provides legal certainty regarding the rights and obligations arising from individual transactions. The private banking sector in South Africa is presently divided between commercial banks, which are regulated by the Banks Act 94 of 1990, mutual banks, which are regulated by the Mutual Banks Act 124 of 1993, and cooperative banks, regulated by the Cooperative Banks Act 40 of 2007. Since the lending activities of commercial banks are more diversified than those of mutual banks, and since mutual banks account for only a relative small portion of the market, in the two LLM modules in banking law, we concentrate on commercial banks. Of course, many of the principles relevant to the activities of commercial banks also apply to mutual and cooperative banks. South Africa's national banking sector has undergone drastic changes and developments in recent years, most significantly in the regulatory environment, starting with the publication of the Banks Act in 1990. There were also new product offerings and engaging the low-income and previously unbanked market. It is generally accepted that South Africa has a sound and stable banking environment. In a recent international study, South African banks came 7th out of 144 countries in terms of soundness. Central banks are generally conceived as autonomous institutions that have exclusive jurisdiction over affairs within their competence and operate at the apex of a country's monetary and banking structure. The Reserve Bank is the central bank of South Africa, and it is governed by the South African Reserve Bank Act 90 of 1989. Broadly speaking, it can be said that the South African Reserve Bank acts as the regulator of banks and banking business in South Africa. Under the previous regulatory regime, it was the duty of the Office of the Registrar of Banks to regulate banks and banking business. However, the Financial Sector Regulation Act, number 9 of 2017, came into force on the 1st of April 2018. It introduced a new regulating entity, the so-called Prudential Authority. The Prudential Authority is a juristic person operating within the administration of the Reserve Bank, and it now acts as regulator of banks and other financial institutions. The aim of banking sector supervision and legislation is threefold. First, it seeks to ensure prudent financial management by banks. Secondly, it seeks to introduce a variety of measures to protect all consumers, but particularly less sophisticated consumers, and to increase the provision of bank facilities. And finally, there have been a number of recent initiatives to increase the provision of banking services to that segment of consumers who are known as the unbanked. One of the ways in which the legislator aims to provide access to the previously unbanked is the introduction of a so-called second and third tier bank system. Suffice it to mention today that these second and third tier banks, which include mutual banks, the Post Bank, cooperative banks, village banks, dedicated banks, and stokvels. The prescribed materials in banking law focus on one example of these second and third tier banks, namely stokvels. In addition, we also introduce you to the concept of Sharia banking. That brings me to the end of my presentation on a broad framework of South African banking law. Thank you and goodbye.